Jim Rickards began his presentation by stating that the conflict in Ukraine had a compounding effect on a breakdown in the supply chain that had been developing even before the launch of COVID. But the trade war that Trump started in 2018 was the primary momentum for this. It is not difficult to recognize a relationship between all of them. If you question him about it now, it will be a very different narrative, and it will also be very difficult to discuss the supply chain disputes that are occurring between China and Ukraine. It is safe to state that the crisis in Ukraine ranks as one of the worst catastrophes in recent history, both economically and strategically. This is because the fight in Ukraine has been going on for quite some time. In the event that China's real estate market experiences a significant downturn, there could be a few problems here and there. Because of the political climate in Ukraine, they are under an obligation to look for refuge elsewhere. As a result, this is most likely the most significant one, but he wouldn't be aware that they are all occurring at the same time. The fact that inflation is such a significant problem has piqued everyone's interest in the topic, but there is much more to the story than that. On the other hand, he is adamant that everyone is an economics expert in regard to their own personal finances. You do not require Larry Summers to explain to you the situation of your finances, including whether or not you can afford to keep a roof over your family's head or provide food for them. As a direct consequence of this, they are affected by inflation. The most common question he receives is, "Jim, is this going to produce a recession?" This is a politically dangerous topic since it is something that cannot be avoided. When do you think the economy will start to tank? And as recently as a couple months ago, he was saying that he anticipates it will arrive either late this year or early next year. Now, though, he claims that a recession has set in. According to the conventional definition, a recession is characterized by a GDP that has decreased for 2 consecutive quarters. Although there are a few extra bells and whistles, such as those pertaining to unemployment and a few other things, the aforementioned is the general guideline. As a result of this, the most accurate forecast for the second quarter suggests that the current economic downturn will continue, and we are currently in a recession. Right now, our country is in a recession, and there is a lot of whistling past the graveyard. The stock market has not yet corrected its significant overvaluation. The buy dips mindset is something that hasn't completely disappeared yet. It has not been removed. There is sponsorship from several institutions. There's something called momentum trading, and nearly all of the transactions in it are handled by robots. So yes, we haven't actually witnessed anything real. The stock market crash that he would anticipate in conjunction with a major economic downturn has not taken place as of yet. This is just how things are going to turn out, and they will get even worse as the year progresses. He has his own model, and he looks at it carefully. However, if you listen to Michael Berry, Jeremy Grantham, and Charlie Munger, you'll hear that their models are wrong. These people have been around for a long time and control a lot of money, but they always say the same thing. So every now and then, when someone gives him a statistic, he asks, "How long is your time series?" He said that he can talk to him if they've been doing it for 100 years, because that makes a bit more sense. But Jeremy Grantham did a 100-year time series and looked at bubbles all over the world. He said he'd never seen anything like it. It is 3 times the biggest bubble of all time. The question that is posed to Jim Rickards by the interviewer is, how do you communicate about inflation with the younger people these days? Jim Rickards told the story to answer his question. Jim thinks about how he and his wife used to joke around with each other. He worked in banking and his wife worked in advertising. Inflation was so bad. Every 4 or 5 months, you'd get a raise without having to ask. They would just give it to you because they knew you would quit if they didn't keep it up. So she would get a raise, and at the time she made more than he did. So they went out for dinner, and when he got a raise, he made more money than she did. So we would just make fun of them among ourselves. Today, we are seeing the highest inflation rates in 40 years. We didn't see these figures until 1981. However, Jim Rickards wants people to remember that the inflation in 1981 marked the end of a 10-year period of inflation. It wasn't the start. It's as if there's no inflation, but it had begun in some ways. It started in 1968, but 1974 and 1975 were the years when it truly took off. In the end, Volcker was able to get everything under control in 1981. Nevertheless, you find yourself back in 1980. In the span of 5 years, from 1977 to 1981, the value of the dollar dropped by half relative to its purchasing power. They are contrasting that with the situation from 9 or 10 years ago, which was a negative development. It had been higher between the years of 1977 and 1978. The question that arises therefore is whether or not this marks the beginning of a rise in inflation. Is it going to get worse over the next 5 years, or are things going to change in that time? Bear in mind, however, that despite the fact that the parallel of 40 years is accurate, it actually signals the end of a far more difficult period. Jim Rickards is of the opinion that the current position is very different from the one that existed in the 1970s. It began on the supply side in the 1970s with the Arab oil embargo in 1973 as a result of the Arab-Israeli War. This war was fought between Israel and the Arab states. The 1970s were the decade during which this war was fought. Following that, there was a multiplicative increase of 3 in the price, yet the total was still $6, up from $2. Despite the fact that this represents a significant increase when represented as a percentage, the total cost is still only $6. And then it got to 12%, and then in 1979, there was a second oil embargo because of Iran. And the Ayatollah won the revolution and the hostages and everything, and it went from $12 to $20. In the late 1970s, the price of oil surged by a factor of 10 as a direct result of the imposition of 2 separate embargoes. This means that the supply side is responsible for this, but the demand side is responsible for the second cost inflation. As a direct consequence of this, cost push inflation occurs. You will be aware of where to go in the event that there is a lack of supplies due to a natural disaster or a trade ban. It is a consequence of the supply side, and because demand is inelastic, you will either need to shell out the money or figure out how to get by without it. On the other hand, there is a much greater psychological component to the demand side. Inflation that is caused by increased consumer demand is referred to as demand pull inflation. When this occurs, customers behave in the manner that he described. And as he claims he lived in the 1970s when there was an attitude of, hey, I better purchase it now, I better do it right now. You are bringing ahead all of this demand, which in turn is driving up prices because you are concerned that the situation is going to grow even worse. We will begin with the cost push inflation because that reasoning pertains to the present day. The cost of energy is the primary component, but the cost of food also plays a significant role. Of course, these two factors are related. You know, it's like here's the energy, and here's the food. What do you believe the source of the food to be? You have to provide the pigs and cows with food in order to obtain the food. What are you giving them to eat? You give the corn to them. But where does one obtain corn? Now, in order to cultivate it, you'll need a farm, as well as nitrogen and fertilizer. In order for your tractors to run, they require diesel. After obtaining the food, you must then load it into a truck in order to transport it from point A to point B, which necessitates the use of diesel. Because food is typically transported by truck, the price of the food goes up in direct proportion to the price of diesel. However, despite the fact that he believes that these things are connected to one another, food prices continue to skyrocket, despite the fact that food and gasoline are the only 2 things that people absolutely require in order to survive. Consequently, price increases are the primary contributor to inflation. What are your thoughts on what Jim Rickards is attempting to express here? Are these beneficial to you? Please share your ideas about what he has revealed in the comment section so we can determine whether or not this is helpful. Stay tuned for more helpful videos like this one to expand your financial management expertise.